And that is the familiar sound of the closing bell at the New York Stock Exchange, capping off another day of trading on Wall Street. The Dow kicking off the week in the red. Look at that, down by about 470 points, 480. The S&P is down by about 1.75%, while the Nasdaq is down by about 2%. For more on this, on the markets, I want to bring in Dory Wiley. He is the president and CEO of Commerce Street Holdings. Welcome. Thank you for joining us here in studio. Always good to have a guest breaking down the markets for us. Can you tell us what was driving all that red that we're seeing on the chart today?
Sure. Market got a little ahead of itself, and it's down probably for three reasons. One, it's a little overvalued. Two, some profit taking, and then three, it got good news and bad news. You know, we get good news out that the services report from November is up. That's bad news for the market. So the market acts a little bit like a spoiled child because it's ready in anticipation for the rate hikes to be over.
And we know that the Fed is expected to raise interest rates by 0.5% by next week. Are you concerned? And we have been wondering about this dance back and forth with the hikes throughout this year, that perhaps yet another rate hike could drive us into a recession?
I think that's what the Fed tells us they want to do.
Yeah.
The market doesn't like the sound of it.
Yeah.
So it's like that spoiled child I was mentioning earlier. Or think of a kid on the way to a vacation. Daddy, Daddy, are we there yet? Daddy, Daddy, are we there yet? No, we're not there yet. The Fed says we need a recession. We don't have a recession. The numbers are too good. So the Fed's going to keep hiking, and the market just doesn't seem to believe it until it happens.
And speaking of that, the November jobs report showed unemployment held pretty steady at 3.7%. What does the labor market need to do for the Fed to feel like those rate hikes are enough? It's
pretty simple series of events. We hike rates, earnings come down. Earnings forecasts for 2023 by the street are still flat compared to this year. They got to come down more. You're still looking at a forward PE of 19. We got to get those down. A typical recession is 10 to 20% down in earnings. So that's a huge drop. And that's not even counting a multiple contraction, on the forward PE. And then lastly, what do companies do? They start laying off. So the effect of the rate hikes that we've had since March have just now started to really occur this fall. And you're seeing those layoffs in the tech industry.
Absolutely.
And we just need to see more and more layoffs so that they show up in the numbers. This 50 basis point pause is great timing because it's not 75 basis points. It's the markets, it's the Fed saying, well, we'll keep hiking, but at a slower rate because we want to give the numbers time to digest what's really going on this fall. So we'll see what happens, and maybe it's only 50 or 25 in February or March. We'll see. But we've got to have the numbers start to show up for the Fed in higher unemployment.
And you got to wonder, is there a way to prevent the layoffs and still get to a place where the economy is in that healthy state without having to go into a deep recession?
That's the wishful thinking. What the market really should be asking, not are we going into recession? We want that because we don't want to have runaway inflation like they do in Venezuela. There's no way to fix that. Well, the real question should be, how bad a recession is it going to be? Can they engineer a soft landing?
Right.
And right now, there's still hope for that because the market is hanging in there very strong despite some big losses in the bond market, big layoffs coming, big drops in the stock market. So I think they still have a decent chance of pulling this off. It's sort of like, threading the eye of a needle, biblically, with a camel or something. But the longer this goes on, I think their odds actually improve because.
I will go ahead.
No, I was just.
That was the thought. Well, I keep thinking of all these metaphors and the different spikes and curves that have been described. The optimal would be kind of a bowl, kind of a pasta bowl. I remember somebody brought up during one of these segments where you don't have that,
Right.
deep recession and see it continue.
Well, the key to the deep recession thing is watching leverage and credit, right? So we get real bad news with this FTX contagion. What is that? Now, it's not like Lehman Brothers, but it's still bad. It's excess. It's got to be worked out of the system.
Right.
And we've all known that it was there in different places. it needs to be gone. The good news is, if you look at the banking industry, it's actually extremely strong, pretty strong capital levels, and the best underwriting they've had going into a downturn that I've seen in 35 years.
So what's bad for crypto is good for banking. Dory Wiley, thank you so much. Appreciate you.